India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning, hello and welcome. You're with us on Bazaar Morning Call, and it's the morning after. You can see the much sort of anticipated and feared US sell-off has happened. Where do we go from here? That's the question. I'm Surabhi Upadhyay. With me is Nigel D'Souza, as always. We'll have Prashant joining in the next couple of seconds as well. Hi, Nigel.
Well, hi, Surabhi. Yesterday was a very, very weak trading session, and now, in fact, a lot of investors are getting a little bit nervous out there. But I'll tell you what, times like these, as we have been stating, they provide a bit of an entry opportunity. And I'll tell you what, this morning, what is positive is we have the RBI that's taken note of the problem and they're trying to do something about it. So I like to see that.
No, absolutely. I mean, and we'll talk about this because it's been a liquidity bazooka that's come in from the RBI. OMOs, VRRR, there are FX swaps that have been announced. But before that, just a word on what happened overnight. And we're talking about the big sell-off. And it was working its way through the system. The market was expecting it and anticipating it, and that's what happened. I mean, the fall on the NASDAQ was about 3%. And, if you look at the individual names, and we'll put some of them up on the screen, the cuts were, there you go. Those were the cuts. And this is the US tech sell-off that we're talking about. NVIDIA made the biggest headlines, 17% down, wiping off about $600 billion in market capitalization. That's bigger than the market capitalization of companies put together, Chevron for one. This was the biggest headline. The question is, now what? What next? Is it done? Or is this sort of dislocating expectations and markets for the next couple of days? We'll get to that in just a bit. But first, let me say hello to Prashant as well. Prashant, what a night.
I think deep seek caused some deep cuts. Right? And I think that's the way to maybe just sort of contextualize this. But absolutely, that graphic showed you, right? Yeah. And you said the NVIDIA cut loss in market cap was greater than companies. I think more than countries. $600 billion. Yes. I mean, I think that's just some incredible numbers. It's the largest ever stock market loss. I mean, ever. So I think, just kind of puts into context the extraordinary gains that names like NVIDIA, etc., have seen. So just to quickly run you through, the last night's session. So it was a AI frenzied sell-off, which led US markets sharply lower. I mean, I think. And of course, it's the Chinese startup DeepSeek's threat to US AI development, which was in focus. I mean, fears that maybe, American AI development companies are falling behind the AI race. Also kind of basically at the core of it calls into question the billions and tens and hundreds of billions of dollars that, large mega cap US tech companies have spent. If a Chinese startup can do it in, 1/10 the cost, what's the point of all these large investments? And NVIDIA, which supplies the chip to be able to do all this sort of AI work, of course, got hit the largest amount. Now, $600 billion erased in NVIDIA, as we pointed out. And of course, on the indices, S&P was down 1.5%, NASDAQ down about 3% or so. I just want to say one thing. When you look at this, it was largely completely tech-focused sell-off. So despite the fact that we had such a large sell-off in tech, only about 30% of the S&P stocks ended lower. And I think that kind of, at the margin, is a bit of a silver lining. And the other one is that the S&P 500's, that psychological level, which is 6,000, that was held, at least for last night. We left off at about 6,012. In terms of macro markets, the 10-year yield lost about 9 basis points, but that's largely a function of the risk-off sentiment out there. So nothing very much happened in the rates market. Oil was down 2%, and I think we left off at about just under $77 per barrel mark. This morning, by the way, there is some tariff talk as well to boot. Apart from all of this, so Donald Trump, the U.S. president, essentially is saying that he'll be placing tariffs on steel, aluminum, and copper, as well as semiconductors. These are comments made in early Asian trade, which I think we'll have to sort of take note of. As Surabhi said, RBI has announced those liquidity measures last evening. The clamor was rising, and if you ask sell-side economists, if you ask stock market investors, pretty much everyone, and this is leading up to the budget, everyone essentially was of the same view that, maybe there's not that much fiscal space, but there is monetary space in terms of easing. And it doesn't start with rates, it starts with liquidity and then slowly moves on to maybe, some rate cuts on the 7th of February. But we'll talk more about that, and Latha will come in as well. But this is important, especially for banks and what they can do for the overall liquidity environment. Now, the Nifty yesterday broke the previous low, made a new low. And I think that, of course, becomes the level to watch on the downside. But, you know, the daily Bollinger Band for the Nifty is also expanded a little bit. So 22,731 is that level. And that's about 100 points away from where we left off yesterday. That's kind of the support here. Upside, 40 hourly exponential moving average is 23,104. So about 200 points, 250 odd points away from where we left off yesterday. That would be the resistance. Similarly, for the Nifty Bank, by the way, the Nifty Bank was a relative outperformer yesterday. Here, the daily low Bollinger Band is 47,290. We left off at 48,065. And then the upside level is the 40 hourly average, which is 48,519 or so. So these are Nifty and Bank Nifty index levels. So you get a GIFT Nifty, I think, indicating a higher start. You will get a higher start. And will we finally sort of, you know, get that rebound, or will things be in a bit of a mix? It is a mix. It is a flux. Absolutely, it's a flux. There is no clear cut sort of, you know, way forward from here. So if you're trading, you'll need to be mindful of all of that. We were due for a bounce even yesterday. It is just that you had this entire deep stick damage, which of course was leading US equity futures lower, and that was an indication which kind of continued to put pressure on Indian and other sort of equity markets as well. So, you know, keep all of that at the back of the mind, but maybe some relief around here possible. And watch out for those first sort of hurdles to be crossed before the market can build and sort of show some more repair and recovery from here on. For the Nifty, that level will be about 23,100 or so. Surabhi.
Yeah, absolutely. And, you know, cues across Asia are anyway thin. So we're back to watching US futures to see what happens from here on. And the futures right now not expecting or indicating a very big pullback after the sell-off that happened yesterday that we discussed earlier on. Declines anywhere between 10-11% all the way up to 17-18% on US tech stocks thanks to the AI scare. In Asia this morning, there are lots of regional holidays because of the Chinese New Year. So China, Taiwan, South Korea all shut for Lunar New Year. Then there are, you know, variable timings for markets like Singapore. They're either shutting early or many of them are closed. So Hong Kong, Singapore. Basically, it's like a black period across the region. The only major market that is giving us an indication right now is the Japanese Nikkei. And that market is slightly lower. And US futures are flat to mild negative at this point in time. So let's see how this goes. The Nasdaq futures have got a little bit of a tick of green on them. Let's move on to then cues that we have here at home, starting off with the fund flow data. Actually, even before the fund flow data, this is what I want to talk about, just to put the fall in context. Now, we all know that the pain in the mid-cap and small-cap space has been absolutely excruciating in the last couple of days. But if you look at the fall from the peak, then the mid-cap index is down about 15%. It's the small-cap and the micro-cap index, which is now just 3% away from the so-called bear market. 17% down on those indices, and the Nifty itself is down about 13%. Where will the buyers come in? That's the critical question. Well, there weren't any, not from the FBI fraternity yesterday. 5,000 crores of selling again happening yesterday, but the domestic liquidity is heartening. And, you know, you really have to thank for all the SIPs that Nigel keeps talking about, the fact that that money, the domestic, you know, mutual fund money, that still seems to be coming in. Now, on the stocks side, of course, bank stocks are going to be in focus because of what the RBI has announced, and more details on this in just a bit. The OMOs are going to be for 60,000 crores. The VRR auction is for 50,000 crores. And then there are the FX swaps that they've announced, which are running into almost $5 billion. So this should alleviate the immediate liquidity stress. Let's see. It's positive for banks. We will see if there is a pop anyway, some sense of recovery that's coming through. A whole raft of earnings coming in, and always a mixed picture as usual. I'll start with some of the better names. Tata Steel looked like an all-round beat. Let's watch out for this. For Federal Bank, the asset quality was fairly steady. There's some margin pressure, but it's not too much. I mean, it's pretty much par for the course, what we're seeing across the system. Coal India, the numbers seem quite okay. Nigel will tell us more about them, but it seems that the realizations are a little better off. Keynes could be today morning's sort of big discussion point, and we'll have the management joining in. The growth is 30%. The market is expecting 55% given the run-up in the stock. So will the market punish it now, given the valuations? Let's see. We'll talk about this. Today we have a full calendar as well. Bajaj Auto and Cipla are reporting. And let me throw in some insurance stocks here, because our colleagues in Delhi are reporting that the amendments to the Insurance Act, they could happen in the budget session itself. And if those amendments come through, then it'll be a raft of changes. I mean, insurers can offer all kinds of policies, life, general. So that composite license bit is being spoken about. A couple of other measures. You can have one agent selling, policies across multiple insurers, which could be a big sea change as well. So watch out for insurance stocks as well. plenty to keep us busy. But as long as, Nigel, the overall picture stabilizes, we don't have that free fall kind of a day like we had yesterday.
Well, that's the hope. And not that we're short of cues, but just to give you another cue today, we have the sensex weekly expiry as well that'll play out. So that'll add to the excitement. Just want to decode a couple of numbers here with regard to the FIs. What are they doing? They're selling in cash market, right? And they're buying stock futures as well. So it appears there's a reverse arbitrage at play. That is sell in cash and buy in futures. So that seems to be a strategy that's playing out. That's point number one. Just wanted to clear the air on that. The next one is the FI net short positions. Now, plenty of debate out there. What's going on? There's been so much of covering, and yet the markets haven't bounced. Because from around 3.5 lakh contracts, it's come down to around 2.7 lakh contracts. But here's the important part. There could be a reason that maybe some of those positions are not getting rolled over, given that we have a big event later this week. So that's why you'll say that, well, the short percentage, in percentage terms, the shorts from around 17%, it's gone up to around 23. The long positions from around 17% has gone to around 23%, or the short positioning from 84% has come down to around 77%. But here's the catch. From the next series onwards, the lot size is going to change. So in contract terms, it appears that the contracts are coming down. But in value terms, actually, it's pretty much intact. So because of the change in the contract size, both on the Nifty and the Nifty Bank, that it appears that the shorts have covered out. That may not be the case, and that is not the case because the contract size itself is moving up. So in absolute terms, don't be deceived that there's already been shorts that have covered out. The FIs are still heavily net short, and we'll have to see how that plays out. So just keep that in mind as well. Moving on to the next data point, the PCR. That's come down to the lower end of the band. It's come down to around 0.76 because yesterday what we saw was there was a lot of put unwinding that was seen. That was puts that were written earlier, and call writing was very, very aggressive. 23,000 call was seeing some writing. The 22,900 call as well. But at the 22,600 put, there was a mix of activity. And, if you put in these numbers and you want to get in the levels, you'll say 23,000 becomes a resistance zone, and any move towards those levels could be met with a lot of resistance. So that's going to be an important part. And going by the options data, the next level you're looking at is around 22,500. And all of the last few days, that support level is moving down. So now we're looking at 22,500 or thereabouts. The RBI has announced the liquidity measures. And if you had to bet on one sector to do well today, it'll have to be the banks and the financials, because tech will be in a bit of a flux. But this sector, should do the heavy lifting. If today we do need to see a bounce, then the Nifty Bank, financials, NBFCs, we'll have to keep an eye out on there. And that's the broad range that you're looking at on that one. Stocks that we're looking at, a few stocks have come out of the F&O ban. So they come up for you on the screen, ABFRL, Bandhan, Canfin Homes, as well as Dixon and LTF. All of them will be, in focus because they come out of the F&O ban. And the stock that I'm looking at, besides the Nifty Bank, I'm looking at ITC. Last few sessions, actually, it's been a relative outperformer. You have the budget, which is obviously an important cue for them. And also, you have their results. So I'll keep an eye out on that one. In the last few sessions, it's not done much. But the Nifty is down close to around 4%. So that's a relative outperformer. I'll keep an eye out on that, big boy.
All right. ITC is going to be in focus as well. Nigel, thanks for that. So let's kickstart the proceedings with the equity call of the morning. Christopher Wood of Jefferies says Breeden Fear has had no exposure of late to hyperscalers in the Breeden Fear global portfolio, but has been investing in AI picks and shovels themes since April 2023. He says, but with DeepSeek developments, Breeden Fear will, ahead of the pending Chinese New Year, reduce holdings in the AI picks and shovels plays in various portfolios, precisely because of the potentially dramatic implications of the DeepSeek news. He says the investments in ASML and Hynix in the global long-only equity portfolio will be removed, while investments in NVIDIA and TSMC will be reduced by 2 percentage points and 1 percentage point, respectively. He adds that investments in Alibaba, HDFC Bank and Brazil's bank Itaú will be reduced with a 4% weightage each. He says the last investment is simply to take advantage of a distressed valuation. So that's Christopher Wood, and he is tweaking his portfolio and cutting some weights in the erstwhile AI czars like NVIDIA.
All right, well, some important view. This is Samiran Chakrabarti of Citi, who's weighing in now on the RBI's liquidity measures. Says that RBI announced liquidity infusion of 1.5 lakh crores via OMOs, forex swaps, and 56-day VRR. He still estimates durable liquidity deficit by end March if balance of payments does not move from deficit to surplus. Consequently, in their base case, Samiran sees possibility of further liquidity infusion by RBI in late February or early March, with quantum dependent on the BOP flow picture. He says these liquidity measures and emerging growth inflation dynamics buttress their view of 25 basis point rate cut at the February MPC, which is in the 7th. He adds market focus could now shift more towards addressing the quantum of rate cuts expected in this cycle, reiterates their bullish view on the 10-year bond yield on account of better supply and demand dynamics and rising expectations of a rate cut. Okay, Rajiv Agarwal is with us now, managing partner and fund manager at Doordarshi India Fund. Rajiv, good to have you with us here. You know, with what's happening in the US, let's start there since you're there and closely watching what's happening. Either this is the greatest buy the dip moment in AI in the US, in at least recent memory, or it's popped. What's your sense, Rajiv?
Hey, Prashant, good morning. Yeah, I think, a lot of new developments are happening in AI. I think what DeepSeek is doing is pretty impressive. But even if AI costs were to come down, I do think that the adoption of AI will increase. And so some of the stocks that have been beaten so badly, my expectation would be that there could be some value buying in that, especially when you go into areas where there is pretty much a monopoly-like situation. So yes, I would expect in some cases, this could be a good opportunity to buy, Prashant.
You're saying opportunity to buy. So maybe even, the one name, NVIDIA is the decider in that sense, right? So you're saying with this cut last night, it's hard to say, right? Or you think, would you, if you had to put money in or decide on NVIDIA, what would you do? What would the call be on NVIDIA? Because that's the call in the US market pretty much.
Yeah, more than NVIDIA, I think the fact that TSMC and ASML are two companies which really have the technology that almost nobody else has, especially when you go to the 3 nanometers and below. And ASML is the one which creates all these machines for the same. I think those are the two very interesting names. Now, we don't own either in our fund, but just in terms of the market hold that they have. In terms of NVIDIA, everybody talks about NVIDIA, but one interesting challenge that NVIDIA would have is how much margins they are making, and therefore a lot of competition is coming from other companies, be it Google, obviously AMD, and so on. And so that I'm a little bit more skeptical there, but I think definitely in some other names there might be more interesting opportunities.
Yeah, we're seeing many of those names on our screen right now, and they're all falling like a pack of cards. At least yesterday, Broadcom, Supermicro, Oracle, Dell, so many other names, right? All fell with a single swipe. So that's on the US, but let's talk about what you're looking to do here in India and whether you've been buying into the fall. We were looking at the stats even here, Rajiv. So the Nifty is down about 13%, and the mid-cap index is down 15%, small caps, micro caps down 17%, individual stocks down a lot more. What have you been doing with respect to India last few weeks?
Actually, we have been buying and we have been early buyers. So we are suffering in the pain that many of us have with the markets going down. And as you rightly said, individual names have gone down more. So yeah, portfolio is red. That's what we have been doing.
Been buying. Obviously, you're not looking at it from the next couple of weeks perspective. You're taking a longer view. Where have you been nibbling?
Yeah, no, I think banking and finance and NBFCs have been our sweet spot. That is where we have been nibbling. And the good news is we almost never deploy a lot of money in one go. And so we have been nibbling at it, as you rightly pointed out. And we feel that, as RBI starts taking measures, as we start seeing some of the pressures start to ease, and that is what we are starting to hear as the Q3 results come out. I feel that it might take another few quarters, but over time, this problem in terms of the stress in the loans and the delinquencies that have gone up will start abating. And I think there is a lot of value, especially in the banking and finance space that we are looking at.
All right, Rajiv, you want to give us some names, banking and financial space. The positive is that the RBI has realized there is a problem. They say that there is a deficit with regard to liquidity and we're doing something about it. So you like that. What have you been buying, though, since you're bullish on the banking financial themes? I think in the past you've spoken about IIFL Finance, Manappuram Finance. You could help me with regard to that, with a few names.
Sure. So I think, Nigel, we own both IIFL Finance and Manappuram, but we haven't really added more of those. I will give you a few names that we have added, and clearly we are biased, so no recommendations. But one of the names that we have talked about previously on your show is Jammu and Kashmir Bank. That is an area we had a new MD and CEO appointed, Amitabh Chatterjee or Chakravarti Chatterjee. So he comes from SBI, and they came out with the first set of results, the Q3 results. We think he will be able to continue the strategy that Jammu and Kashmir Bank has in terms of growing their book in that particular state, as well as look at other aspects, be it the treasury, be it lending out in the corporates. And I believe that him coming should allow the bank to grow the book over time. Again, none of these necessarily will start giving us results in the next few quarters, but I think over the next few years, I think it could be an interesting opportunity. The other one, where we have been a little early, has been in the microfinance space. And as you know, microfinance space has been beaten badly. One of the names that we have taken an initial position in is Spandana Spurti. Again, that has been actually locked on in the lower circle for the last few days. So that is the name that I can talk about.
I mean, and hopefully things recover and everyone does better, because right now it's painful. Rajiv, thank you very much as always for being here with us on the program. Appreciate it as always. Well, I just want to quickly highlight Prime Minister Narendra Modi and his conversation with the US President a week after Trump was sworn in to office for his second term. The two leaders reaffirmed their commitment for a mutually beneficial and trusted partnership. They also discussed a range of regional issues, including security in the Indo-Pacific, West Asia and Europe. The US President emphasized the importance of India increasing its procurement of American-made security equipment and moving towards a fair bilateral trading relationship.
Okay, all right. So that, of course, was the other headline that came in from yesterday. Those are, of course, earlier visuals that you're seeing on the screen. Let's talk about the corporate interactions that are lined up now. We have at 8:35 Mr. Jairam Sampath joining in. Like I said earlier, Keynes could be the big debate today, whether this 30% growth can keep the market happy or not, given the stock valuations. We'll ask him. At 9 o'clock, we'll connect with Akash Ohri of DLF to talk about the demand trends and their latest projects. At 9:20, Ashwini Agrawal of Demeter Advisors joins in. He's our market master of the day. At 9:30, we get chatting with the management of Canara Bank, talk about the Q3 performance and the outlook ahead. At 9:40, you will hear a lot of perspective from Pankaj Tibrewal of Ikigai Asset Management, Anish Tawakle of ICICI Prudential, and Harish Krishnan of Aditya Birla Sun Life Mutual Fund, all of them talking about their budget expectations. At 9:50, we will have the management of Federal Bank joining in to talk about the Q3 performance and the outlook ahead. And finally, in our special segment, It's the Economy, today Lata will be in conversation with Pranav Gundapalli of Bernstein, as well as Shantanu Chakrabarti of BNP Paribas on the impact of RBI's liquidity measures on banks and the Q3 numbers so far. Well,
okay, all right. So that's essentially the lineup here, and let's go straight to that big story, which is RBI's liquidity enhancement measures that were announced yesterday evening, much awaited. Lata is here, and Lata recently wrote an article as well, I think, over the weekend, sort of talking about exactly this issue. Lata, good morning.
Well, yes, this is absolutely liquidity floodgates when you look at it first sight. But let's look at line by line. To buy 60,000 crores of bonds in the open market, 3 dates, Jan 20th, Feb 13, and Feb 20th. Now, they're releasing money in slow, it's 20,000 crore that they're buying at each point in time. So that's a slow purchase and therefore release of money, positive for bonds and banks, of course. Then the 56-day repo is important, 50,000 crore. You know what's a repo? They take government securities as collateral and give money. 56 days later, the transaction is reversed. So for about 2 months, banks have the security that I have this money with me. Why? You can see it very clearly. It will tide over the March 15th advance tax outflows, etc. But why Feb 7th? That's the day of the policy. Now, if they do a VRR before that, banks will not apply because you don't know. You are applying it at 6.5% repo rate. And you're taking the money at that price. And then if the rate falls, So February 7th is crucially placed. Some people are taking it as a hint that maybe there is a rate cut. But really, the Reserve Bank has played it clever. The 5 billion of FX swaps for a 6-month tenor. Now, a FX swap it's a buy-sell. They buy dollars today and the sell is 6 months later. When you buy, you're obviously infusing liquidity. This is to neutralize short dollar positions the Reserve Bank has already taken because they're selling dollars. Those are short dollar positions. In the NDF market also, they have taken these positions. This kind of neutralizes that. That's why this is given. Now, the impact, total amount, if you count, 45 billion would be about 45,000 crores at today's dollar rate. And plus the remaining, it's about 1.5 lakh crore. That is Reserve Bank prepared for the 1.5 lakh crore of deficit that is still coming. So it meets that number. Typically in Q4, there is also a lot of cash withdrawal. Well, now what are the market's readings? The market's reading is that only so that their rate cut will be effective. In a tight liquidity situation, bankers will still be hankering of why they're preparing the situation, and maybe there is not a likelihood of a CRR cut with a 4% CRR. They want to use it only, like Lehman crisis or something very big, 8%. So there is no need to do a CRR cut. That's the reading of the market at this point in time. Impact, well, immediately, of course, for bonds, it's good. One big buyer is coming and promising to buy 60,000 crore. So you should see a rally in bond prices and yields move ulta. So you will see the yields falling towards the 6.6% mark. And if you're expecting a rate cut, it can fall even further. At the moment, overnight rate is 6.5. 10-year at 6.6, it's a practically flat yield curve. So market will start pricing in that maybe there is a rate cut. Now, if there is a rate cut, then while banks are going to benefit because their bond prices are shooting up, there is a mark-to-market gain. A rate cut, as we all know, will mean that their external benchmark linked loans will fall. So there is actually a marginal crunch in the initially. So I'm not very sure whether banks will be very cheerful today. They have a positive and a negative, but NBFC stocks, other interest rate sensitives, I think they will be a little more advantaged.
Okay, so Lata, that means that the 7th of February becomes another red letter date. We have already marked.
Very big.
Very, very important. And on the CRR and the crisis, my God, I hope I never live to see another Lehman, at least in my reporting career. That was another crazy error, right? So hopefully we don't ever get into that kind of a dire situation anytime in the near future. But this issue about tight liquidity, this was actually raised by bankers as well as NBFC heads in Davos as well. Shireen had spoken to a bunch of them, and they had all been sort of speaking about the need to infuse more liquidity in the market. Let's just revisit what the ask was, and a lot of that has been perhaps fulfilled by the central bank overnight.
I think what the system needs more is liquidity back in the system. One, secondly, deposit growth to pick up a little bit. We also need some of the macro, regulations which RBI has brought in or is talking about bringing in. RBI to kind of, sit back and think through as to how they want to implement it and when they want to implement it. For example, if they implement the LCR, kind of the draft guidelines as the way they exist, we are talking about 5 to 7 lakh crores being taken out of the system. So it will have an impact. So my view is that on the rate cut, they might do it to give a signal, but is it going to spur economic growth? I'm not so sure.
There are some important measures the regulator has taken of late, particularly to infuse additional liquidity.
Has it helped?
Particularly daily VRR definitely had sent signal to the market that the liquidity support from the central bank will always be available. We are able to see the change in the market perception in terms of the liquidity availability. While the system liquidity is still tight and is deficit, but the availability on tap liquidity from RBI definitely is a good indicator.
Yes, liquidity is very low at this point, as you know, negative 2.5 lakh or so. We need to pump in greater liquidity. Second, liquidity is not really a challenge for the big banks. But you have to keep in mind that a large part of our system and our credit that goes into tier 2, tier 3, certain segment of society and below is NBFCs. And these are large NBFCs. Some of us are bigger than most banks. You need to make sure that similar kind of liquidity lines are created for us.
Okay, all right. Well, time to slip into that short break. But as we come back, we'll go full tilt on all the top 10 stocks that we're tracking for you. For the time being, I'll run you through the list. We're looking at Tata Steel, Coal India, Bajaj Housing Finance, Piramal Enterprises, IGL, 361 WAM, as well as Imami. All of them will be reacting to positive news flow, while Keynes, Federal Bank, Union Bank of India will be reacting to negative news flow. Take that mandatory break, come back, we'll go full tilt on all these stocks.
Welcome back. So the cues across Asia are thin. Two major markets, Hong Kong and Japan, are trading, and they've been trading with a fair amount of caution. We, of course, are expecting a bit of a recovery maybe after the slam dunk yesterday. So the implied open is suggesting at least a positive start for what it's worth. Ned, let's now talk about the whole raft of earnings and news flow that we were dealing with after market hours yesterday. We have our team standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Nigel, let's start with the big boy first, Tata Steel. I mean, first glance, the numbers look okay, but what's the fine print? What do you think?
Well, the first glance, the numbers look blockbuster, but that wasn't the case. There are a couple of adjustments, but yet the numbers are better than what the sheet was working with. So the revenue number was a little bit better. The EBITDA number that you saw, well, that looked much better, but the EBITDA number included a reversal of an older provision, which was to the tune of around 1,400 crores. So stripped of that as well, the consolidated EBITDA number is more or less in line with what we were working with. Now for Tata Steel, you look at two crucial numbers. One is the standalone, the India EBITDA per ton, which is a little bit better than what the street was working with by around 300 rupees or thereabouts, because the fall in realizations wasn't as much as what the management had guided earlier, and they've got the benefit obviously of lower input costs as well. So India was a little bit better, and the European business losses were less than expected. So that's good news. How do they manage that? Because the Netherlands business slipped into the red. Steel prices out there were very, very weak. So that was the issue out there. However, the UK business losses, that halved. Why is that? Because they've shut down their furnaces. So the fixed cost came down drastically. The net debt number as well did come down by close to around 3,000 crores because of release of working capital. So put everything together, the operational performance, better performance coming in from India, European losses a little bit lower, and the net debt coming in lower. I'm going with green on this one. The stock should react positively to this set of numbers.
Okay, so Tata Steel looking good. What about Coal India, Nigel?
Well, Coal India as well, I'm going with green on this one, because remember, Coal India, they've changed the way they account for various items, but going with green out there. Let me give you the rationale. The top line, well, that was a little bit better than what we were working with, very little better, but that was good. The EBITDA number as well, a little bit better, and the profit number a little bit better out there. How do they manage this? The employee cost was down by close to around 3%, and the stripping activity credit, which is effectively an accounting entry, out there the credit was close to around 1,900 crores. Most on the street were factoring in 1,000 to around 1,200 crores. So because of both those two, yeah, the operational performance was better. The overall realizations, well, they came in high. That's a blended realization was up by close to 3% on a sequential basis. But if you split it up for our viewers, between FSA as well as e-auction, FSA realizations, just take a look at that. That's improved by close to around 4% because the grade mix was better. So that's what's helped the blended realizations to come in better. And e-auctions as well on a sequential basis, that's seen a recovery of around 200 rupees per ton. So good realizations, better than expected realizations. The e-auction premium has moved up now to around 76% from around 69% in the previous quarter. And also they've declared close to around 5 rupees of dividends. So give and take everything. Going with green on this one, it has valuation comfort as well. So Coal India should react positively.
Okay, all right. That is Coal India. So thumbs up for both Tata Steel and Coal India. Let's move on. Some BFSI numbers now. Abhishek, you're watching out for Bajaj Housing Finance as well as Piramal Enterprises?
Well, Bajaj Housing Finance, it was a good quarter for them with respect to the AUM growth that they have had. It's up 26% YOY and about 5.5% sequentially. The disbursements growth was strong, around 4.5% sequentially. That's aided the AUM growth this time around. Net interest income is up almost 25% YOY and about 13% sequentially. The PAT is up 25.5% YOY and about 0.4% sequentially, largely impacted by the provisioning which has shot up multifold times on a sequential and YOY basis. The net interest margin has come in at 4% versus 4.1% in the previous quarter. Asset quality largely stable at 0.29% gross NPA ratio. Piramal Finance, the disbursements and AUM growth are in single digits. So disbursements are up 8.7% YOY and AUM is up about 9.6% YOY. That's on the weaker side. On the good side, the net interest margin has expanded 5.7% versus 4.9% in the same quarter last year and about 5.1% in the previous quarter. Even their asset quality has improved, so gross NPA ratio is down to 2.83% versus 3.1% in the previous quarter. Back to you.
All right, Abhishek, thank you very much for that. So that's Piramal Enterprises in focus. IGL is the next one we're going to turn our attention to. Sudarshan is here with more. So good morning.
Morning, Prashant. So IGL earnings are looking better than estimates, mainly led by volumes, which saw an increase both on sequential and year-on-year basis. Even on the guidance front, 9-month FY25 earnings are looking in line with the guidance that company has given for FY25. Talking about the operating numbers, EBITDA has come in at rupees 364 crore, which is 24% higher than our estimate. Even margin is coming at 9.7%, which is almost 200 basis points our estimate of 7.8%. Now, talking about the one important tracking point, that is EBITDA per SCM, which is coming at rupees 4.34. That is also 22% higher than our estimate of rupees 3.60. So overall, on the earnings are good, given by IGL for Q3. Now, conference earnings call is at 4 p.m. today. 2 points that will be in the focus. First, what is company's plan on the pricing front? And second, if company has heard anything from the government side on APM gas allocation.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Abhishek. He's here to tell us about Federal Bank and Union Bank. Abhishek, take it away.
Well, both of them had a similarity, that is weak business momentum. For Federal Bank, the business momentum on a sequential basis is one of the worst that you are seeing in last 14 quarters. Deposits are down 1% sequentially. Advances are almost flat on a sequential basis. The net interest margin has come in at 18-quarter low of 3.11% versus 3.12% in the previous quarter. The credit deposit ratio is at 28-quarter high of 86.5% versus 85.5% sequentially. The asset quality continues to remain robust for most of the financial entities. So gross NPA ratio is one of the lowest that you are seeing in last 9 to 10 years at 1.95% versus 2.1% in the previous quarter. Provisions are elevated at about 292 crores this time around, up 84.5% sequentially. We need to understand from the management what caused the spike in these provisions. Union Bank of India deposit growth at just 3.8% YOY, one of the lowest in last 13 quarters. Advances, it is down 2% quarter on quarter, one of the lowest that you are seeing in last 10 quarters. Advances growth are at just 2.7% YOY, one of the lowest in last 12 quarters. Slippages have declined massively. They had a one-off in the previous quarter. Asset quality, 10-year low, gross NPA ratio at 3.85%. Weak underwriting standards because write-offs continue to remain higher than slippages this time around. Operating profits are down more than 7.5% quarter on quarter, and that is why the PAT is down 2.5% quarter on quarter. Back to you.
Okay, all right. Got it, Abhishek. Thanks for that. We will, of course, connect with the management of Federal Bank. They are joining us at around 9:50. So we'll talk about some of those issues. The business momentum that Abhishek is saying has been weak in the third quarter. Moving on then, we have, the spotlight on 361 WAM because not just the business performance, but the fact that they've bought one of India's oldest brokers, BNK. Vamakshi, morning. Tell us more.
Well, absolutely, Sudhvi. Let me first start off with the numbers. ARR, that is the annual recurring revenue, is seeing an uptick of 7% sequentially, more or less in line with what the street was anticipating. The transaction and brokerage income, on the other hand, has seen a dip of 6%, but this is much better than what the street was anticipating. And overall, the revenue is seeing a growth of 3% sequentially, slightly better than what the street was expecting. When we look at the cost-to-income ratio, that has shot up by 196 basis points sequentially, and this is led by higher employee costs as well as admin and other expenses. basis. Resultantly, operating profit has dipped 1%, but the net profit is up nearly 12% sequentially, and this uptick is largely being driven by the sharp jump that we're seeing in the other income. Apart from that, more importantly, the company has announced the acquisition of BNK Securities India Private Limited and Batliwala and Karani FinServ Private Limited. The total consideration for BNK Securities is at 1,774 crores, which is a mix of cash as well as proposed preference issue, while for Batliwala and Karani FinServ it is at 109 crores. So total somewhere around 1,884 crores is where the acquisition is at a price to for BNK Securities the price to sales comes at 12.3, while for Batliwala and Karani FinServ it comes at 8.1. So overall, a good set of numbers. The acquisition coming through bodes well for the company.
All right, Vamakshi, thank you very much for that. Imami reported numbers as well. Mangalam is here with details. Mangalam, morning.
Good morning. So it's a better set than peers, when it comes to Imami's third quarter numbers. Why do I say that? Because the sector is parched for growth. In that, Imami has done 5.3% revenue growth, and at a time when most companies are reporting margin contraction, Imami has gone ahead and reported EBITDA growth of 7.6%. Yes, the margins have improved by about 70 basis points, but they've improved as against contractions reported by peers, and the net profit has increased by 7% as well. It gets better because the core domestic business has actually grown by about 9%, with an underlying volume growth of 6%. So that's something that, most companies report when the going is good, and Imami's done that in tough period as well. At the same time, the winter products, where a lot of companies called out seasonality impact, delayed winter on their winter portfolio. Look at Imami's winter portfolio. Boro Plus grew by about 20%, healthcare grew by about 13% as well. So these numbers, in light of the environment in the consumption sector, along with the valuations at which Imami trades at, stand out as brilliant. So expect the stock to see green today.
I completely concur with that. They do look brilliant when you have large companies reporting flat growth, no growth, or, those anemic 1-2% kind of numbers. Not bad. Let's see how Imami does. Mangalam, thank you for that. And now let's come to the big one. Kaynes Technologies. The reason we're calling this big is that it's a mixed bag. The growth is slowed down, though there is margin expansion. Upasna, EMS space always hot. Tell us more about Kaynes.
Well, good morning. The numbers have missed the earnings expectations. Now revenue PAT below estimates, while EBITDA margin is largely in line. Now let's talk about the revenue growth first. Now revenue growth has slowed down in Q3 FY25. Revenue growth stood at just 30% versus the expectation of 55% to 60% on a year-on-year basis. Now there's a sharp rise in employee expenses and other expenses leading to overall PAT miss. Order book stood at 6,047 crore with an uptick of 59% on a YoY basis, which was much strong as anticipated. Now looking at 9-month FY25 revenue, it stands at 1,737 crore with an uptick of 50% on a YoY basis. While with this number, it is difficult for the company to meet its FY25 guidance of 3,000 crores. Now coming to the numbers, revenue saw an uptick of 30%. Which was much below our expectations. EBITDA stood at 94 crores with an uptick of 34%. EBITDA margins expanded by 50 basis points at 14.2%. And lastly, PAT stood at 66 crores with an uptick of 47% on a YoY basis below our estimates. So all in all, numbers are a miss.
Okay, all right. Thanks a lot for that, Upasna. Let's hop across to Manisha. She's here to tell us about the commodity markets. Manisha, take it away.
Well, thank you for that, Nigel. I'll start with the crude oil prices, which have seen a constant decline, another 2% of a fall in the overnight markets. And with this, the WTI is now trading at a 1-month lows and the Brent crude price is at a 2-week lows. We are facing the weak China economic demand, U.S. tariff uncertainties, also the U.S. sanctions on Russia, and now Saudi Arabia is signaling intentions to raise oil prices for Asia. And not just crude oil prices, which have been declining. It's a similar state for the metal prices also, where overnight, because of the weak Chinese data, we have seen copper prices decline by 2%. Aluminum is trading at a 2-week lows. Nickel prices at a 4-year lows as well. Same is the case with the precious metal prices, where gold is off its 2-month highs now, and we've seen a percentage point decline on both gold and silver markets. Well, we have seen money flow into favored fixed income and defensive equities, but markets feel that Fed will deliver 2 rate cuts in 2025, and that in turn could be supportive. But overnight markets, clearly, everything is in a decline.
Okay, all right. Thanks a lot for that, Manisha. Well, we'll slip into a short break. On the other side, we'll focus on Kaynes Technologies. Stay with us. Welcome back. You're tuned in to Bazaar Morning Call. As promised, let's get straight to Keynes Technology. The numbers, in fact, looked good if you look at it on a year-on-year basis. However, they were short of street estimates. Mr. Jairam Sampath, the whole-time director and CFO of the company, joins us on the show. Hi, Mr. Sampath. Good morning, and thanks a lot for joining in. You have delivered a growth, but it's short of street expectations. Give us one quick number. 3,000 crores for FY25. Is it on or not? Could you tell us about that? I ask you this because you've done around 1,700 crores. To hit 3,000 crores, you'll have to do 1,300 crores, which will be a growth of more than 90% on a year-on-year basis on the base of Q4. So is 3,000 crores on? We unmute yourself, sir. We'll want to hear you.
Sorry about that. Good morning. Thanks for having me here. So obviously the news is mostly good and a little bit of a challenge on the quarterly number alone. We have had good growth in the order book, which is fundamentally drives our business. There have been good expansion on the margin. This is one of the key planks on which the company's performance stands. So there have been obviously last quarter, we couldn't convert about close to about 100 crores of orders in the industrial, which if we had done probably would have looked far superior. Okay, be as it may, going forward, obviously we have 3 months left. So practically speaking, we'd probably deliver a growth of about 60% over last year. So now it looks like we will reach somewhere between 2,800 to 2,900. We try probably nearer to 2,900 crores this year. Closer to March, we will know exactly where we will be. So this is not because of any weakness in the business front. It is execution that got delayed in the third quarter. As you know, the first 2 quarters are also because of the elections, etc. Some of these 50% of our business comes from government influenced purchases.
Okay, so, got it.
Yeah.
Got it. All right, sir. So 2,800 crores is what we should brace ourselves for in comparison to 3,000 crores earlier. We have got that on board. You know, you were talking about your profitability, and one line item that stood out was the employee cost. As a percentage of your sales, that's moved up by a couple of 100 basis points, though your gross margins improved. Explain this to us. Was there any one-off out here? Was there some new hiring? Because you're going in various verticals. So is it because of that?
Yeah. So obviously there's a reduction in operating leverage. Our EBITDA margins could have been even better. It's grown on a 9-month basis. 40 BPS could have been even higher. So we have acquired a lot of new teams and companies, both in the smart meter area, some yet to come to revenue kind of relationship. We have acquired something in US too. So all of these things put together, the employee cost surges a little up. But I think they will all account for themselves in terms of business in the fourth quarter. And so this is part of the business wherein you acquire costs a little higher, a little earlier than you acquire the revenues and profits. So nothing, yeah, it's not a one-time thing. It's a regular growth phenomenon.
Okay, sir. So the market will sort of, weigh in on that explanation quite carefully. Can you then guide for when this normalizes the employee costs and what would the margin trajectory be? Another thing that's being pointed out was, working capital staying at elevated levels, some free cash flow issues as well. Now, I don't know if that's just a Q3 phenomena or whether that evens out. If you could just throw some light there, as well as on the actual margins, exit margins for the year and what the profile will be through FY26.
Sure. So like I mentioned at the beginning, about 100 crores of orders we didn't execute because these are into industrial area. It's a new area, a little larger volumes, etc. It has taken some time to kind of get hold of this. Orders are still there with us, and we probably will execute most of it in the coming quarter. So in terms of margin trajectory, we probably do better than 15% EBITDA for the whole year. And like I said, between 28 and 2,900 should be our trajectory for revenue numbers, operating revenue numbers. And this particular cost expense increase is not a one-time thing. So obviously, these are all businesses which are also going to grow. And we think that it will normalize by end of the year where we start getting some positive, let's say, operating leverage out of these costs. So like I have said before, firstly, you get an adverse impact of costs, and then you start getting positive impact of, let's say, business.
All right. Jairam, hi, morning. So for 26, 27, what kind of top-line growth rate should we expect? What should we model in?
Yeah, so we had been always talking about a 4,500 crore revenue. I think that looks doable now. We obviously we've been kind of targeting more than 60%, etc. this year. For some reason, in the first 2 quarters have been.
That's fine. You're saying 4,500 crores in FY26.
Yes, 4,500 crores because we'll have 2 new businesses kicking in too. So they will also have some, let's say, pulling power. And so all put together about 4,500 on a consolidated.
With 15% kind of margins?
Yes.
Okay. Now, just one point I wanted to clarify. Are you finding it, by the way, how much of the components, etc., that goes into what you make comes from China? If you can give us a sense, Jairam?
Yeah, so typically in a business like electronics, almost 30% is China influenced components. 10% of them are PC boards, and then remaining 22% are generic components that come from China. So obviously going forward,
has there been any issue with sourcing, etc.? Or it's all very smooth, no problem? Because we've heard from 1 or 2 other companies that, and you must have read articles, etc., highlighting that there is a bit of an issue.
Yeah, not in our business. We have not yet so far. Unfortunately, we work with a little bit of inventory, so it doesn't affect us in the immediate term. I think going forward, I don't think it will be any different from past. So any improvements that comes through is basically operating leverage plus better gross margins. You might have noticed that even we have done a better gross margin this time. So obviously, despite not having the railways and things like that firing up, I think we've done a good, pretty good show. In fact, the order book addition has been in the area of aerospace defense, has been area of new generation of automotive and also industrial. So that is also qualitatively better than earlier book increase.
Yeah, that's the bright spot. Gross margins were better and order inflow was good. Very quickly, sir, the QIP is on, and what is the purpose? The stock is down 20% in the last 10 days, I think so. Is the QIP on, and what is the purpose of the 1,600 crore fundraise?
Yeah, so the QIP is not based on stock price, it is based on what we acquire.
Correct.
So there are 3 things that we wanted to do. One is we want to add additional geographies because I think US government, there is a change of government and they have been talking about manufacturing within the US. So we need to get our act together and we need to do some inorganic acquisition somewhere there and grow the business there because that's a huge geography compared to India. Our primary story of import substitution still continues, but we need to add now work hard and add additional geographies like US, Europe, and also South Asia. That's one. And second thing is we need to strengthen our credentials in the ODM segment, wherein we have our own designs. And we have already done one experiment with Sensonic and very encouraged by that. And then we want to add some more. And the third one is we want to deepen our technology presence because going forward, like I said, technology is the basis on which we'll fight.
So money could be used for buying a US-based company, a company in the US, or setting up something in the US because to avoid all this tariff.
One of the things in the, let's say...
apart from the other 2 things that you outlined. Got it. We're short of time, Jairam, but greatly appreciate you coming on and explaining all of that to us and our viewers here on CNBC-TV18. Good luck. 4,500 crore revenue guidance for 26 with 15% EBITDA margins. And of course, there are these new business lines which are also going to start to fire up. Stocks come off a little bit, but so is the market. We take a quick break here. We'll come back with Amnish Agarwal of Prabhudas Lilladher with some fundamental stock conversation. Stay tuned. Okay, welcome back. Amnish Agarwal, Head of Research, Prabhudas Lilladher, is now joining us. Amnish, good morning. Good to have you with us here. I'm not sure while you were waiting, you could hear the Keynes conversation, the Keynes sort of management conversation. If you did, any thoughts? Stocks in that space have come off 20-25%, maybe more in some cases.
Yeah, hi Prashant. This entire EMS space has been getting a lot of attention because there's a lot of growth momentum which is there. But having said that, if you look at the multiples, most of these stocks, I think barring a case here or there, they have been trading anywhere 40 times, 50 times. So there was no margin of safety. Now looking at Keynes numbers also, I think there is some cut in estimate which is likely to happen. post the conversation which I heard. And then there's a lot of element of other income which is there in the profitability. And if you exclude that other income, I think the growth in the third quarter has not been that exciting. So I think looking at the market sentiment, I think in the near term, all these momentum stocks or the sectors, they are getting a hit. And I think Keynes can get some more hit that particular event. In the long term, yes, is import substitution and all those, I think things will pan out. But in the near term, all the momentum sectors are suffering. And given the fact that there's an equity dilution, plus the numbers have been, I think, relatively on the, I would say, lower side. And the next year's your growth projection, which the management cited anywhere up to say 43 to 4,500, that also looks quite, challenging task. So I think it's more like a wait and watch in the current scenario.
Okay, so you will sort of hold the horses there on Keynes Technologies. Amnish got that. Want to talk about, 361 Wealth Management. A lot of news flow coming in. They're getting aggressive in terms of their sort of positioning, right? With this BNK purchase, plus the numbers also came in yesterday. Overall environment is not very supportive of capital market related stocks. But how would you look at this one?
You see, if you look at the entire industry, it is getting actually consolidated. So this 361 actually it came out, I think, from ILFL at some point of time, and now they are going into, you can say, broking and all again. So I think if you look at most of the capital market entities which are listed today, so everyone today wants to have your entire bouquet of offerings under their roof. And to that extent, I think 361 is no different. So in the near term, yes, the market volatility is there and all the capital market entities, they are under pressure and they can come under more pressure. But in the long term, I think having a platform which gives you access to your in-house research, which can then be taken into other segments, I think that is definitely a positive for 361.
Absolutely, and I think it'll be interesting to see because that space, of course, in the capital market space has also been heating up. By the way, look at what's happening, Amnish, the other names, right? Novama is down to $5,000. You look at many of the others out there. It's all a function of capital markets and how they do. Any thoughts here on any of the other names? I mean, BSC, Novama, there are so many other, of course, wealth management companies listed now.
Yeah, Prashant, so typically what happens is that when the market going is good, so they all the capital market entities, depending upon what their business mix is, if you are having an AMC under your fold or if you are having a treasury and if you are having a broking, then obviously the overall volumes improve and your income goes up. In the current context, I think all the capital market entities can remain under pressure because kind of rout we have seen in the markets, particularly from the last month or two. So I think 4Q numbers for all the capital market entities, they can come under significant pressure. So I think in the near term, capital market entities could come under some sort of a pressure. But yes, in the medium to long term, once the market stabilizes and the things look up, I think they should be again back into action.
Okay, all right. Stay on, Amnish. We'll have some more questions for you in just a bit. Need to take a quick break. We'll come back with our technical experts as well. Mitesh Thakkar as well as Sudarshan Sukhani will join in to tell us how to approach trade today. Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studios, and we have our technical experts now joining in how to approach trade given the big sell-off yesterday. Mitesh Thakkar as well as Sudarshan Sukhani are both with us. Gentlemen, good morning to you. Mitesh, are you looking to buy or still waiting and watching?
See, Sulvi, I think till yesterday there was no sign of going and venturing and taking long positions in the markets. Even today, I don't think a 75-80 point kind of a gap up could reverse it. But what is important is that we are getting more and more oversold. So the first thing which the market should do is capture 23,050, which was the Friday's low, and close this gap which opened yesterday. I think once that happens, that will be the first sign that the market is trying to fight on the upside, and then we look for some reversal signals on the charts and then go long. Till then, I think wait it out. There's strong support around 22, 550, 600 zones. Maybe we'll test that. I still believe that. But looking at the oversold levels, I think we are not aggressively short.
Okay, not aggressively short anymore. Got that point. Sudarshan, what about you? Do you think today could be the day that the dust settles? Will you venture out looking for long trades or no?
Yeah, good morning. Yes, it could be. And it's difficult to say whether today will be the final sort of end of the decline. That is not what I'm meaning. But it's an interesting day to watch and to trade in. After many days, I think there is a trade opportunity opening up. There are two reasons. First, it's not just the implied open that the Nifty is suggesting a positive start. That, of course, dissipates so many times earlier. The reasons are that the Dow was actually up even when the S&P 500 was down. And that shows us the divergence. We are not a tech-heavy country, so the decline in the American markets should actually not affect us at all, as it did not affect the Dow there itself. The second is that there is some news about the RBI. That seems to be good. The third is that the fact that the tech stocks in US are actually falling and going out of favor could be beneficial to us in India. I mean, India could again be the flavor of the day. All this is just imagination, but these are possibilities. All said and done, after yesterday's deep sell-off, a buying opportunity emerges today. Now you have to be patient and see whether it works out or not. But after the first gap up, buy a small dip.
Okay, got it. Gentlemen, let's come to stocks as well, individual trades. Mitesh, which stocks will you go with?
I'll have more of long positions today, long calls looking at stock which can give a reversal. And the first one is Federal Bank, which is a buy with a stop at 188.25 for targets of 186. Bandhan Bank is a buy with a stop at 145 for targets of 158. And Bajaj Auto, I think, formed a slightly mildly, bullish candle signaling short-term reversal. That's a buy with a stop below 82.95 for targets of 86.40. And one sell call, which is HCL Tech, keep a stop at 17.37, look for targets of 16.55.
Okay, got that, Mitesh. Sudarshan, what about you?
Well, I also have more buy calls. Torrent Pharma is a buy with a stop under 32.50. Eicher Motors is another buying opportunity with a stop under 5,085. Ramco Cement, which had a decent correction, is now looking up, buy with a stop under 875. And my only intraday short is Escorts, where it is possible to sell a rally with a stop above 34.30.
Okay, all right. Thanks for that, Sudarshan, and good to get that from you. By the way, you got the rates coming up on the rupee market, 903 now. So yields and rupee, I think we put out an alert yesterday as well. So things are moving around there as well. The dollar rupee up on your screen, 86.53 is where we are at, about a 0.25% change this morning. I mean, these are large changes which are coming through. And I think this latest move, perhaps, of course, could be on the back of the rupee, on the dollar rupee bid, by the way, could be on these Trump tariff threats. Once again, I mean, it's become a little jaded now, but this is for, I think, at least after he's taken office till now, and we'll play those sound bites out. Till now, it was largely looking like, he's taking a more negotiation kind of a tactic. But this morning, early in Asia, he's kind of, that's President Trump has gone on and said there's going to impose tariffs on steel, aluminum, copper, even pharma, and of course, foreign chips, etc. Unless and until all that stuff is not made in the US. So, just something new at the margin. But that's that. We'll take a quick commercial break. Okay, I think Sudarshan and Mitesh, thank you very much for joining us. We'll come back to you in just a bit for more. But Amnish, in this entire financial space with what the RBI has done on liquidity, etc., even as a trade, maybe as a tactical thing, what looks best placed? I mean, is it something from the NBFC space? Is it large banks, mid-tier banks? What would be your pick?
At this point of time, the large banks, like for example, if you look at even the numbers, your ICICI or the quota for HDFC, I think they look best because in terms of say numbers, in terms of balance sheet, they are well placed. But in terms of say purely the liquidity injection by the RBI, or if you are expecting a rate cut to happen towards the later part of this month. And I think the initial, you can say, in addition to banks, some of these, your large NBFCs, they might also be the gainers.
Okay, all right. Let's talk about a couple of those coal/metal companies that came overnight, Amnish. What's your view? Coal India as well as Tata Steel, both those numbers are relatively better in comparison to our poll. Your take on them?
The numbers were better, but there's a probability of an estimate cut, for example, as far as the Tata Steel is concerned. And a lot will depend on how the global situation goes, both in terms of demand and also in terms of any tariffs, etc., which the US imposes. Now, in terms of steel, everyone is actually expecting and depending on if there is some anti-dumping duty imposed by the government, if there's an uptick in demand. In the longer term, things are looking reasonably good as far as your domestic scene is concerned. But I think a lot will depend upon, I would say, what happens on the international side, both in terms of demand as well as in terms of pricing. So not a very, I would say, aggressive calls to be taken at this point of time. And we would watch as to how the clarity emerges in the coming few months.
Okay. All right. Got that, Amnish. We'll leave it on that note. Thank you for joining in. By the way, quick check on the pre-open, and it is looking good. BFSI is leading the charge from the front thanks to the help coming in from the Reserve Bank of India. Nifty's popped up 120 points, and the biggest constituents are BFSI players: Shriram Finance, ICICI Bank, Bajaj Finance, Axis Bank, Bajaj Finserv, SBI. It's a solid morning for this entire space. And the other trend to keep in mind would be Keynes. Keynes in the pre-open is down about 8% as that disappointment plays out. We heard the explanation from the management, but the fact is growth is a lot lower and margins are lower than street estimates in the third quarter. And let's see if this dip gets bought. That's going to be the critical question today. But for the time being, let's move on to some more corporate commentary. DLF reported a strong set of numbers for the third quarter. The company reported its best ever quarterly new sales booking. On a high base, the company saw a very strong response to its super luxury projects, Camellias and Dahlias in Gurugram. Our colleague Tim C. Jaipuria caught up with Akash Ohri, Joint Managing Director and Chief Business Officer at the company, and asked whether this growth was sustainable.
What are your measurements for that sustainability index is something that we can talk about. But I think today, how does a city develop? Gurgaon is looking at a 20-year infra plan. It's got one of the most amazing set of residents who are extremely involved. It's an inclusive growth story. You have most of the Fortune 500 companies here. You have great leisure facilities. You have the best homes. You have great schools. What else do you want in a city, closer to the airport? So as the city develops and it is keeping a lot of those environmental norms in place, I don't think, I'm not saying everything's hunky-dory, but as long as the administrators are planning for the urban infrastructure to be, working with the private developers, I think Gurgaon has seen a spurt of growth over the last decade, which the infra has taken time to catch up. But I think right now all the planning is towards that. I'm seeing it to be one of the most modern and developed and most preferred cities to live in. I think that's what the government will also be working towards. So as far as prices are concerned, I think they're also very dependent on where people want to live and what is their choice of the city that they want to live in. And the price is a subject to that. Obviously, if you give them a good offering, if you give them great products to live in, with the social, very strong social and hard infrastructure, I think price will become a byproduct of that.
So price will become a byproduct of the mix that they are getting in Gurugram, be it infrastructure or the area where they are living at. Meanwhile, when are you launching your project in Mumbai? Just shifting focus to that project, what is the sales potential of that project in Mumbai, and how much revenue are you going to recognize in this quarter from this particular project?
Mumbai is slated to be end of the quarter, as you know, as per our guidance and various reports. It is a Q4, Q1 product. There is, to start with, we will be, it's about 2,000 crores to start with, but we will, I think about 1,000 is what we are intending to do.
All right, that was DLF with the business outlook. But back to our technical experts. Let's get some final trading ideas in before we kickstart the action. Mitesh, so it seems like, your thesis of going long, maybe that will play out at least at the start. What's the stock call?
I'll go with the buy on Bajaj Auto, extremely oversold, so this could give a good bounce back for targets of 86, 40, 50.
Okay, and Sudarshan, what about you?
Well, consider buying Eicher Motors with a stop under 5,085.
Eicher Motors and Bajaj Auto, very interesting. Both are technical experts going with two large cap tech picks in the two-wheeler space in terms of immediate trades. All right, gentlemen, thanks very much for that. But let's move on. There are a couple of very interesting brokerage notes, which are actually, buy calls as well. So let's go across to Sudarshan to figure out which ones he's looking at. I think Siemens is one of those stocks, Sudarshan, right?
So I have three brokerage upgrades today. First one is UBS has upgraded Siemens to buy and target is rupees 8,000 per share. It says market is under appreciating earnings resilience and business mix is now more diversified and resilient than peers. It finds risk reward favorable as valuations are now close to 5-year average. Second is Nomura has upgraded Balkrishna Industries after earnings. It has upgraded to buy and target is 3,242. It says companies poised to benefit from demand recovery and also valuations here are attractive as well. CLSA has upgraded Chola Investment Finance to outperform from whole and target is 1450 per share. It sees high teen AUM CAGR despite lower vehicle finance growth. Also, it finds no concern related to asset quality and finds valuation reasonable after stock has seen a correction of almost 30%.
Okay, all right. Sud, thank you very much for that. That is Chola in focus this morning. There's about 3 minutes to go for the market open, and there is a fair bit which is happening out there. 130 points higher, it'll be good to get an open around the 23,000 odd level. 23,100 approximately is the 40 hourly exponential average. That's the first resistance, you start to trade above it, hold on above it, and maybe some confidence starts to come back, at least in a very, very precariously poised kind of situation. Just look at banks and, the Nifty bank actually should come up on your screen. Maybe the Kotak and the ICICI and the Bajaj Finance of the world, all part of the Nifty. But also, of course, names like Indocent, etc., which have been beaten down quite badly and fairly quickly on the downside. So mid-tier, what about NBFCs, right? I mean, again, big cracks we've seen come through recently. And of course, not even getting to the microfinance space, which should be in focus. Actually, let's just look at Credit Access. Credit Access started, I think, 15% lower, and I think it ended flat or maybe even slightly higher yesterday.
Yes.
So that was a complete U-turn. But this morning is down about 3% in the pre-open pre-open session, with just about 2 minutes to go. I don't know if we have Mitesh with us, and we'll be able to go across to him. But this is the broad area of financials, which I think should be in focus at this point in time. Anything else, guys? You noticing?
Just revisiting.
Keynes I saw was a big...
Keynes is 8%. It's still down 8%. The other one is Pratap Snacks. The snacks are not too hot. There's a loss Pratap has declared in the third quarter. So that's another stock that's getting a drubbing. But Imami, and Mangalam rightly pointed this out, in a sea of underperformance, Imami's growth, which is I think 5 to 6% on the top line, and reasonably decent on margins. They've managed to inch up margins a small bit. The market's really taking that because we haven't seen this from any other FMCG company so far. So Imami's been looking good. There's Piramal Enterprises, there's Union Bank. Piramal Enterprises also good numbers. Margin expansion coming in for Piramal Enterprises. So these are some stocks that are reacting pretty positive to earnings. So I guess, folks, it's going to be a day when we kick off with a bounce back. Big question is, can it sustain?
Absolutely. And, the market open will tell us, maybe not the open, but at least it'll give you a sense, really. So it's green for now, 0.5% in the Nifty. Nifty Bank is up double of that, about 1%, 48,500. The sensex is up about 0.5%. Mid-cap index is up about 0.4%. And the small cap index, small caps, of course, the index itself is down 17% from its all-time high. So that's taken the biggest knock out there. It's flat actually, nothing, the small cap index, but too early. 100 points on the Nifty, about 22,900. Sensex at about 75,745. Market breadth is about 2:1 in favor of advances. And what do we have? As far as the Nifty heat map is concerned, 35 names higher and about 15 stocks which are starting in the red at this point in time. Surabhi.
Okay, it's green all the way, 110 points up, and it's BFSI that's leading it. Shriram Finance 3% up, Axis Bank 1.5%, HDFC Bank 1%. There's IndusInd Bank, there's Bajaj Finance. So banks, NBFC stocks across the board higher on the liquidity boost that the RBI is injecting. As Lata said, the rough calculations show that all of the three measures put together, the swaps, the OMOs, the VRRs, all of it put together amounts to almost 1.5 lakh crore rupees, and the market loves that. Okay, what else? There's some rebound in the tech space. So names like Infosys slightly higher. There is Trent, which is the worst performing stock of 2025 on the Nifty, by the way, so far. Serious price damage on Trent in the last 3 weeks. There's some recovery today, 1% higher. Adani Enterprises about 1% up as well. And there's BEL, TCS, HCL Tech, like I said. So tech is looking good. And then it starts fizzling out. On the downside, Sun Pharma, Dr. Reddy's, Cipla. So pharma seeing profit taking. There's some Coal India. Let's talk about the result reactions. Didn't get to that. Coal India is down about 0.5%. Let's see what Tata Steel is doing. Flat. Tata Steel is also slightly positive now, about 0.5% up, as the numbers didn't look bad. So that's on the downside. Some profit taking in FMCG names like Britannia as well. So it seems pharma, FMCG, basically the risk-off sectors are on the red side, and BFSI is leading from the front.
Well, that's right. I'm trying to look for some positive earnings reactions. I found Updata. That's the one that is listed, I think, a short while back. Updata Services, that's up close to around 7%. So that's some green that we're seeing out there. Solara Active Pharma, that stock is down another 7.5%. It was under pressure yesterday as well. So that one's coming for a bit of a pounding. You have Prudent Corp. We'll get the management later. Volume's not very, very high, but that stock is down close to around 7% as we speak. So sharp pullback is what we're seeing. Credit Access Grameen, it moved 20% yesterday, intraday. But that one, in fact, for starters, that's down, in fact, close to around 5% as we speak. So big pullback is what we're seeing out there. Sudarshan Chemicals as well as another stock, not very, very high volumes, but that as well is down close to around 5% as we speak. So the headline index from being up close to around 130 points, well, that's still up close to around 90 points. The Nifty Bank, that's the ones that's powering away. And CDSL, after seeing a cut yesterday, it's down another 4% in today's trading session. But good to see a few of these banking names in the green. Union Bank, Bank of India as well, pointed out Canara Bank as well in the green as we speak. And Greaves got in. I think Mr. Purunjo, a noted investor, he's bought yesterday in a large trade. So I think that's one of the reasons why the stock is up 3%. Even in yesterday's trade, to be fair, it was higher in trade by close to around 3% or thereabouts green. Let's hope we end the day in the green.
Yeah, there's Mahindra & Mahindra Financial Services, by the way. They report numbers today, if I remember correctly. And obviously, there's the overall move on BFSI, taking things higher. M&M Finance up 4%.
It's a lot of financials, of course. I think in terms of the top movers, it's largely financial services. Novama is coming up. I was talking about the wealth management company, and this deal was also Novama is up 2.5%. But of course, Novama is not just wealth management. Samman Capital, I mean, these are some of the smaller ones, is up about 3.75% higher. LIC Housing Finance is starting about 2.5% up. There is a Bank of Maharashtra, 3%. Indian Bank is coming up with something. J&K Bank, I think Rajiv this morning was talking about that one, 3% higher in J&K Bank, 92. And of course, you've got the Chola Finance of the world, PNB Canada, Bank of India, Piramal Enterprises, and Union Bank, which are on the leaderboard this morning with volumes as well. CDSL, I'm not sure we mentioned, is down another 5%. Yeah. And look at Anantraj. Anantraj got smashed yesterday. So basically on last Friday, it closed at 810. Yesterday, it closed at 670, 668 to be precise. 810 to 670. And today at about 628. It's recovered, by the way, from the lows. The low today is 604 and about 623 right now. So that's a big volumes as well. 1.4 million shares now up on your screens. So it's widely traded. The other continuing accident is NetWeb Technologies, right? We had the management with, I actually looked this up yesterday. We had the management with us on the 20th of January in the morning. It closed that day at, it opened at 2300, it closed at about 2200. But from 2200 in the last, 5 or 6 trading sessions, it's now at about 1450, 1460. That's a massive move coming through. on net worth. It's almost as if the floor has fallen through. It's literally the definition of that, which is kind of come in. Of course, I mean, valuations at that point were 100 times. I mean, even on the 20th of January. Now, of course, it's fallen quite a bit. So I'm assuming valuations would have come off as well. But it's a big fall. SW Solar is another continuing accident, right? No flow. It's down to 300 rupees. High was about 830 about 5 or 6 months back, 7 months back. PG Electroplast is another EMS company, 6% lower right now. Keynes, of course, is the big one, 12%, but there's PG Electroplast down about 5.5%, 6%. These are all stocks which have gone up 10 times or so in the last couple of years. VATech Vabag is continuing to fall. It's down another 4% this morning. Decent-sized volumes as well. A fair bit happening.
By the way,
right now.
Prashant, overall, look at the mood in the mid-cap market. The index is already flattening out, and this was the risk the market was running. But I think it's very early. We'll probably have several waves, peaks and troughs through the course of the day. Might be that kind of a day. But there's no immediate huge excitement and huge bounce back after the dropping yesterday.
It depends on the kind of mood you're in, right? Keynes, one would have argued when the stock was going up, it delivered 1,300 crores last year. This year it's going to do closer on 3,000 crores, which now we understand it's closer on 2,800 crores. And in the next year it's going to do 4,500 crores. So growth, it deserves that multiple, trading at more than 100 times
and
now.
they're investing in the business. The hike in employee costs is because they're adding more businesses. All of that. That's bull market,
Correct.
psychology.
But now you're saying, look at the price you're paying. And guess what? From the start of January till now, how much is the stock down?
30%.
40%.
Oh, gosh.
With this fall, it's down 40% as we speak. So that's the mood of the market as well. If you promise, they should have given a heads up or something on those lines. You can't pull back on, when you're trading at these valuations, there's no room at all for any kind of error. You would have said the street saw it coming. That's why the stock was down 25%. Guess what? It's down another 12%.
No, absolutely. And, essentially very, very rich valuations and some reality check now coming in. Somebody who's been saying that a reality check is coming for some time now is Ashwini Agarwal. He's our guest now on the program, founder and partner at Demeter Advisors. Ashwini, good morning. Good to have you with us here. Thank you for your time. And, this is... portfolios now comfortably, I think, across the board should be between 25 to 35%. I mean, if you were in more riskier stuff, very high P stuff, you'd be down more. But everyone is down, varying degrees now. What's the sense, Ashwini? Where are we and what do you see ahead, near term?
So, morning, Prashant. Thank you for having me here. All of us knew this was coming, right? We just didn't know when, and we just didn't know why. The point that Surbhi was making earlier on the show is that these things were trading at 3-figure digit PE numbers, and those kind of PEs are never sustainable. Very rarely have those kind of PEs survived, to deliver stellar returns, over a longer period of time. So I think this is the reckoning that the market is going through. Obviously, the investor sentiment is now short. So anything that doesn't have a modicum of value is being sold off. I think that cleanup will continue for a while. The dispersion in the small cap stocks across the valuation scale is very, very large. So, you have stuff trading at half times price to book among some of the financials, and then you have companies trading at 100 PE on the other hand. So my sense is that not all is lost. Even if you go back and think about what happened between 2018 to 2020, and I dare say that this is not as bad as what we went through back then. You had stocks, you had ideas that delivered you reasonable returns if you knew where to look. So I think that's what's going to happen ahead. I think we should expect flatlining of the frontline indices, maybe some more downside in mid and small. But I think there will be rich pickings if one were to be willing to look deeper.
Ashwini, hi. Thank you so much for being with us this morning. It's always difficult to buy because when the serious money is made when you buy when there is enough pessimism, when there is no clarity about the future. It's very easy to buy when there's clarity. Then you only have to worry about valuations and nothing else. But this is a time when valuations may be in your favor, but narratives, numbers, none of that seems to be adding up. So in this environment, what are you looking at? Where would you deploy money?
So, interesting question, Surbhi. I hinted at financials. Okay, I'm looking at some of the financials which are trading well below book or at book. where businesses are well run. I don't see the outlook for financials to be as challenging as it was back in 2018. I don't see any macroeconomic imbalances. I don't see, there's some stress in credit quality on the unsecured borrower side, especially individuals, but outside of that, there is really no stress. So, that's one area I'm looking at. I'm still looking at chemicals where business cycle has been very negative from an earnings perspective last 2 to 3 years, overstocking, high raw material prices, et cetera, et cetera. A lot of that has washed through the system. So that's again looking quite interesting to me. I think frontliners, there are some places where I can see some value. That's also looking interesting to me. And there are other manufacturing companies, bottom-up ideas that look good. And as you say, it's hard to buy when, the tape is so red. And the only thing that I do in times like this is say that, if I have 100 rupees of cash, I'm going to deploy it over the next 3 months. So you buy every day, you buy a little bit, and then you buy a little bit lower, and that's how it goes. We'll see how that plays out.
You said financials. Ashwini, if you could be a little more specific than that, because it's such a large, umbrella, capital markets, insurance, lenders, non-lenders, all of that, BFSI, large banks. So what now? So again, some of the small banks, some of the life insurance companies among the frontliners, some of the, even microfinance. I mean, some of the microfinance companies are now trading below book. I mean, these business models have survived. These are very well capitalized balance sheets backed by strong promoters. It's just a cycle. I mean, the way I think about microfinance is that when you make a 10% spread, that spread provides for a poor cycle every 3 to 4 years, and that's what you're going through. And, I don't see these businesses blowing up, unless, of course, there's some regulatory intervention. I mean, we saw this unfortunate comment from a political leader saying that, there should be a cap on rates. I mean, I think that shouldn't happen for the simple reason that these companies bring credit to those who have no access to credit from elsewhere. And if you don't allow a risk spread to emerge, this business will not be there, and those borrowers will be forced to go to local money lenders. I mean, show me NBFCs or microfinance companies that over a cycle have made a 25% ROE. Nobody has. So where is the question of excessive spread? I mean, these are well-run businesses. They're not overly leveraged, and they have strong promoters. So I think, there might be an opportunity here. It's going to be painful. You can't call the bottom, but I think over a 3-year time frame, there's an opportunity.
All right, Ashwini, the real pain today is in the EMS space. Keynes, that stock is down close on 17%. If I'm not mistaken, you have been cautioning as well that party is getting too exciting. Be closer to the door, otherwise you're going to be stuck out there. What do you think? I mean, Keynes has pulled back 40-45% in a matter of, I think, less than 20 sessions. Your view on this space?
Nigel, when I was a young man and I had entered the market 30 odd years ago, there used to be a company called Samtel Color, screwdriver technology. They would buy the color tubes, they would put a TV together, and we all thought that it was a great business. It wasn't. I mean, I think the EMS companies are good businesses. I'm not comparing them to Samtel in the sense that they'll go bust. But I think that they are good businesses only to the point of, an assembly operation. It's a very simple operation. It requires scale, so that requires a certain management skill. But beyond that, what is it? I mean, and why should I pay 100 times PE or 150 times PE? I mean, I don't quite get it. So, I think, yes, if you ask me to buy these stocks at 30, 35, 40 times PE, when they're growing at 50, 70%, it makes sense. But at 100 times PE, it doesn't make sense. So, you're paying for the next 3 years of growth, and you have no idea what's in store 3 years down the line. So, I continue to stay away.
Yeah. Absolutely, and I think that's exactly the dilemma that the market is dealing with now with the EMS stocks. Keynes being the latest example. Ashwini, little short on time because of all the earnings today, but thank you very much. We look forward to a longer conversation next time you're with us. Have a great day. Okay, earnings in full focus, and Canara Bank is the next stock and the next company on the radar. Now, yesterday there was disappointment coming through, and why do I say that? Because the net interest income was down 5.3%, and deposits don't seem to be growing that steadily or that robust a fashion for the bank as loan growth. So we'll talk about this with the management. We have, of course, Mr. K. Satyanarayan Raju, Managing Director and CEO of Canara Bank with us. Mr. Raju, thank you so much for joining in. So I'll come to this NII situation in just a second. But first, let's talk about the big headline of the morning. It's a good headline, right, from the Reserve Bank of India. This liquidity boost that's coming in. To what extent will it help you in terms of margins, in terms of, just the business overall? If you could give us some sense.
Yes, madam. Actually, our credit growth, if you look at that we have given, when we have commenced our financial year this year, we have given 13 parameters for guidance to the investors. Out of these 13 parameters, already 9 parameters we surpassed by the end of the December quarter itself. The major thing is the advances growth. What we have predicted, we have given the guidance is at 10%, but we could achieve around almost 10.45 to 10.5%. This has helped us in increasing the interest on loans and advances. But you might have seen that the NII is negative. But the NII negative is only because of last quarter, the one-time benefit of 320 crores from one NPA account. It has we could recover that 320 crores from that NPA account. That is a one-time benefit. But at the same time, the second one is the liquidity operations in the market. The overnight investment or any that's short-term investments when you have a surplus liquidity in the system. But this time we have not used that window, but we have used the advances window so that we get a higher returns. That's why the loans in the interest portion on the loans and advances has considerably increased. But the only thing, the other interest income has shown a decline. Except that nothing is there, and we are on very strong footing. And here afterwards, that NII will continuously grow in the quarter-on-quarter basis. Regarding the liquidity.
So, sir, just if I've understood you correctly, what you're saying is that in the base quarter, you had that one-time boost, a bump up because of the recovery from or the sale of an NPA account, which is why you had that additional 320 crores. You didn't have that in the current quarter, right? And then obviously the liquidity operations and what you were doing, that didn't quite add up, if I understood you correctly. So if you could just tell us, now there is anyway liquidity support that's coming from the Reserve Bank of India. What can we expect on NII and the margin as well in Q4?
See, especially because yesterday we have seen the announcements by the regulator that they are injecting some liquidity in the system. If the liquidity improves, the major concern is interest on deposits, madam. Garnering the deposit is not a concern for us at any cost. But the garnering at what cost? That is the major concern. We are cost consciousness. That's why we are growing at 8.5 to 9% what we are given the guidance. Otherwise, if that liquidity improves in that, definitely we expect that some softness may happen in the market. Once that deposit rates started coming down, then it will have a positive impact on our NII. Unless otherwise the liquidity in the market is improved. Otherwise the NII will continue at 2.8 is the present level, whatever it is there.
Deposits, I mean, a lot of the other banks, both PSU and private sector, many of them have managed a deposit growth in double digits. Some have even gone to about 15% on the private sector bank side. So wouldn't you say that, your deposit growth is a little, lower than the industry average? Is this just a one-quarter phenomena? And how do you see deposit growth shaping up in the coming quarter?
Actually, we have a 8% excess SLR, madam. So, and keeping that excess SLR idle may not be a good idea for our business proposition. That's why we are using that window available with the regulator, and we are raising the funds from the at a repo rate that is coming at 6.5. And when you are getting at 6.5, raising the deposit at 7.7, 7.8 may impact our bottom line. That's why we are using this, because we have that liquidity comfort in that. The second one, what I want to tell you is, the retail term deposits, we are more interested on that instead of going for a bulk and high rate of interest things. We are continuing to garner that retail term deposits. Even the December month, we have initiated 2 blocks, that is a 2 to 3 years and 3 to 4 years period, the 3 to 5 years period, 2 blocks, we increased the rate of interest. Because of our increase in the rate of interest, we could garner 8,000 crores. And our CD ratio is still below our expectation of 78%, because the SLR is 18% and CRR is 4%. That requires 22%. We want to keep internally that our CD ratio at around 78%. When you have that cushion, so that's the reason we are going little slow on the term deposits. Otherwise, garnering the deposit is not an issue, but garnering in the savings bank and CASA is definitely a concern that we are trying to address with various products and services.
Okay, all right. Hi, sir. Good morning and good to see you. And thanks for the clarity on the NII parameter as well. But give us two basic numbers. What is the credit growth target that you have? There has been, we're looking at the data and there has been a slowdown for the industry at large. So for your bank, for this year, what should the credit growth look like for the next year as well? And what is the NIMs, the broad range we should work with?
So the growth rate, definitely we are given a guidance of 10% that we can surpass it, that growth rate. That may not be a big issue for us. It is because intentional calls only what we are taking it. Advances growth, earlier when we are given the 10% growth, that itself time I have shared with you that we may grow at around 11%, and we are expecting this quarter we may touch that 11%. So overall these things, most of our guidance, whatever we are given, we are going to surpass that guidance. The NIM, there's definitely a concern. That's we are expecting that the present level cumulative NIM, whatever it is there, that's a 2.8 to 2.83. That may be the reason, because let me see that next 2 months, if because of the regulatory actions, if the liquidity increases, if the pressure on the term deposits with rate of interest decreases, we may improve 1 or 2 basis points better in the NIM. Regarding the next year, our credit growth definitely we. Tell me, madam.
No, sir, please continue.
No, regarding the next year business growth, we sure that we can continue. See, initial year when we have projected 10% credit growth, the market has taken it as if we are conservative. But now the industry itself has proven that what we are given is a correct guidance, but we are surpassing what guidance we are given it, not like other banks. So next year also there is a strategy meet is there in the March month. We will decide, we will discuss there, and I'll come back and share it with you that what the guidance next year is there.
So like you said, I mean, between 10 to 11% perhaps growth in the loan book. What about growth in deposits, sir? FY25, end of FY25 versus end of FY24, year on year, how much would you have grown your deposits by?
Definitely, and I feel that we will cross that 9% guidance, whatever we are given. We will surpass that guidance, madam.
Okay, and the NIMs, like you said, would be around 2.8%, 1 or 2 basis points, depending on the liquidity announcements. Sir, just to wrap this up, to go back to today's RBI announcement, this, OMOs that they've announced and the VRRs that they've announced, immediately, do you see any benefit, any relief for you?
Definitely there will be a benefit, madam. When the market is 60,000 crores, if they are injecting the market, the pressure on the bulk deposits will come down. But we have seen recently, because that demand for the bulk deposits has increased in the market and it has crossed 8%. At least that will be softened immediately. That will help the banks to focus on lowering the interest on deposits, madam.
Okay, very quickly, if you could help us out with what are your expectations of resolution on the NCLT cases, sir?
See, last quarter we got around 653 crores through various resolutions through NCLT, whether it is a resolution directly or the liquidation or whatever it may be. And we are expecting in the current quarter also through NCLT around 600 to 700 crores we are expecting to recover on that. We already identified in advanced stages are there 2-3 accounts. We expect that this quarter also will be there. In regarding asset-based side and all, whatever you are strong, what the performance we are showing last 2 quarters continuously will continue in the third quarter also. Our recoveries will be much higher than our slippages.
Okay, all right. Mr. Raju, we'll leave it there, sir. Thank you very much for joining us, and it's a pleasure having you here on CNBC-TV18, taking all of those questions. We'll take a quick commercial break here. Markets are up about 60 points, which means that we've come off quite a bit from the highs. I think about 60-70 points off the highs already. We'll take a break here. We're going to come back with the discussion on markets and where we are now. So Pankaj Tibrewal, Anish Tawakle, and Harish Krishnan bring in their perspective on the correction that we've been going through over the last couple of days and where is the bottom. Stay tuned. Okay, welcome back. Well, the markets, of course, trading up but off the highs. Time for some more sort of perspective on markets from people who've been around a while. The CNBC-TV18 budget town hall, I caught up with three market veterans, Pankaj Tibrewal of Ekagai Asset Managers, Anish Tawakle of ICICI Prudential Mutual Fund, and Harish Krishnan of Aditya Birla, Sun Life, AMC. Spoke to them about the budget expectations there. They're running kind of low. But more importantly, where we are in the markets after the correction we've seen. Listen in.
So from a downside perspective, I don't think there's too much of downside now. Roughly this year we will do about 1030 on EPS, our estimate on Nifty. And this year is coming to an end in 2 months. Next year our estimate is about 10 to 12% growth. So say about 1150, 1170. At 22,000 levels, the valuation will be about 18, 19 times. I think it will be in a fair zone rather than being very expensive or very cheap. I think unless a very big event happens globally or locally, then it's a different thing that you can undershoot, overshoot. But I think it will be a good time to start, buying into the market. But I think at this point of time, what not to do will be most important. I think don't buy narratives. Don't buy broken balance sheets. Don't buy companies which have governance issues. And cash flow is an issue. So I think the basics of investing should be back in action. And my sense is that over the next 2 months, markets will provide you this opportunity. And I think intuitively, we get excited that whenever there is a sharp sell-off, because you are buying quality companies at your own pricing. So I think that is coming after a long time. And probably this can get extended, but I think...
so another 5% on the way down?
Maybe index? If I was to take a guess, yes. But many micro caps, nano caps, small caps, I think far more downside left. Because they have been re-rated significantly over the last 3-4 years. And if the business doesn't support, I think you could see further downside. But I think this will be the time where I am turning a little more constructive on the markets post the sell-off. And the reason I said was this time there's no solvency issue on the balance sheets of corporate India or bank balance sheets. Hence, this will be a shallow correction rather than a very deep and a prolonged correction. So next 2 months, I think, will be a great opportunity from investment perspective and taking on risk on your equity portfolio.
And large cap, but what I'm hearing is more large caps than small, micro.
So I don't think this will be a time where large, micro, small. I think go bottom up. Select best businesses which you like, which are leaders in the sector they operate in. Only avoid sectors which are trading at cyclically high margins. Because we are in a supply side economy this time. Broken balance sheets have been repaired. People have got money from QIB IPOs, so they are competing with the incumbents. So sectors which are trading at very cyclically high margin, there's a risk that competition can lead to margin dilution. So keep that in mind. And I think broadly bottom-up stock picking will be the way to go. And I think next 12 to 18 months, market will be in a consolidation mode. We will not be seeing a very sharp move up again. And I think this time around, we need to be very careful that...
But there should be opportunities emerging in the next 2 months. 100%. So I'll come back on sectors in just a bit. Harish, what about you? What's your view?
So I think this year is more macro and the next year is micro. Now, obviously, you need to think about creating portfolios over the course of the next 18, 24 months. And therefore, the rate of change of macro variables is very important. So like we spoke about the monetary impulse, that can be a very big macro driver. And linked to that can be a whole range of financials which have been on the back foot for a long period of time. Similarly, potentially a fiscal change in
monetary
stance.
bit eases off a little bit in all ways, basically, over the next
so
6
it need
months.
not be only about rates, it could be about liquidity, but more importantly, it could be about signaling of various actions, right? So a lot of that comfort, if it can come through on Feb 7th, I think that can be potentially a big rate of change out there. We are also amidst global macro environment wherein whatever Mr. Trump says is being viewed very carefully.
Although that's kind of taken the backseat, right? Since he's and it was almost like sell the rumor and now.
That's right.
Not buy the news, but do nothing.
I personally feel that, even as he's got an absolute majority, okay, I think there's a strong check in the form of the bond market in US. And the 10-year bond going close to 5%, which is the nominal GDP growth rate, is never a good news for any politician over there, right? And so therefore, closer to 470, 480, the degrees of freedom that Mr. Trump enjoys actually comes down significantly.
So the market here, significant. You don't think there's significant downside? You think for over the next 6 months, things will change, both on the monetary, maybe on the fiscal side, and that will revitalize things a little bit.
That's right. So I think that, earnings support for the next 2 quarters might be very limited, but you don't buy businesses for the next 2 quarters. You're buying for where they will be over the course of time. And as Pankaj said, we don't see stress in the real economy. It's only about the lack of growth at this point of time. And if that can be seen over the course of the next 18, 24 months, whatever we are today feeling that the street is feeling very despondent, I think can very quickly change over the course of the next 6-8 months.
But that needs that help from monetary or something has got to change.
Monetary, fiscal, and even currency. So even that lever, one shouldn't forget that currency depreciation also helps earnings growth in nominal asset classes.
Purely from a mental makeup, are you guys buyers?
Absolutely. So we've been adding on risk at this point of time, increasing our equity levels in the funds that we manage.
Anish?
So I think large cap valuations, as Pankaj was saying, are in neutral territory. They're neither expensive nor cheap, which basically means that, so the way I define it is that if it's cheap, then you can buy it, and not worry about anything. When it's neutral, that means returns will depend on the earnings outlook. I think earnings outlook for large caps is reasonably sound. So one can start entering large caps with a 3-year horizon. Right? I don't think one should enter with a shorter horizon than 3 years. I don't think we are done on small and mid caps. I think there is significant risk. If you are a small cap investor, then you have to be careful and look at bottom-up opportunities, avoiding these things. But I run the small cap fund. I'm still struggling to find enough really attractive small cap stocks, let me put it this way, right? To create a portfolio, I'm not saying there's not one here, one there, right? But to create a portfolio, you need
after the show, I'll give Anish.
Happy to take ideas, but I'd still say, look, in small cap, be very, very careful.
P multiples are still very rich.
So, I say it's not, there's valuation and there's categorization. Valuation is, something is, we can discuss, right, whether 19 is the right multiple or 18 is the right multiple. And frankly, there's no right answer. And the reality is, if you get 10% growth, and you've bought, between the 19 and 18, the difference is 5%. So if you get 10% earnings growth, the debate is over in 6 months, right, by flatlining. What I mean by categorization issue is people have not understood the risks of the stock they're holding. And when they fall 20%, people will come and say, oh my God, who was holding this? And come to sell. That's what I mean. They're weak companies, overrated sort of TAM. TAM is a very abused word. Right, and weak governance also. So I think one has to be very, very careful still in small and mid caps.
Small cap, but large caps, you're saying?
Large caps, you can invest.
Okay, well, that's a sampling of views from some of the most seasoned fund managers. Anish Tawakle there of ICICI Pru, he runs a small cap portfolio, saying significant risks still there, but large caps you can buy with a 3-year view. This Pankaj Tibrewal saying that maybe there is opportunity over the next 2 months, which will start to emerge. And of course, Harish Krishnan, you heard as well. Well, Federal Bank is the next company on the program. The stock is a bit under pressure. Now, net profits have come in below expectations. Slippages have come up a little bit. We have Shalini Warrior, Executive Director at the bank, now joining us to take some questions. Shalini, good morning. Good to have you with us here. Thank you for your time. I just want to start with the higher provisioning, which a lot of analysts are pointing out. in terms of what is the reason behind this higher provisioning? Are you anticipating stress to emerge? This is contingent provisioning. So are you anticipating stress to emerge in what segments? And broadly, the thinking behind this?
Sure. Thanks very much. Good morning once again to everybody. And before I just get into that, let me just give you a couple of highlights so that it sets the context in which this additional provisioning is done. First of all, we'd like to confirm that at an operating profit, this has been a record quarter for us. The operating profit at 1569 crores has been the highest operating profit that we've had. While it's flat a little bit Q on Q, it's up 9% Y on Y and 14% on a year-to-date basis. NII has also been pretty significant at 2431 crores. Deposit growth, asset growth, I will talk about in a little while, but let me just address the point on additional provisioning that was highlighted in our investor deck. First of all, this is not, a generic provision. What we have done is a certain portion of our advances, notably our credit cards, personal loans, and microfinance, we have taken provisions at an individual level which are higher than what would be normally required from an IRAC perspective or from a regulatory provisioning perspective. So what would have been provided a few quarters later have been brought forward. And we've done this in recognition of the fact that, one, from a market comparison perspective, this places us better in terms of our provisioning. Two, the fact that these portfolios do require higher provision to enable us to make sure that the risk-adjusted returns are duly stated as we grow these portfolios. And third, it takes us closer to an ECL perspective because we do recognize that expected credit losses regime is going to come in. So taking all these into account, we took certain parts of our portfolio, and from a timing perspective, what would have been provided in the future has been brought forward. The attention, therefore, in my view, should be really on the credit costs. And if you look at it this quarter, yes, there has been an increase in credit costs because of this additional provisioning that we have taken. However,
Shalini, will this be, sorry to interrupt. So this is for credit cards, personal loans and MFI portfolio, right? And you're saying this would have come in a few quarters later. You've done it now. Will this be utilized in the next 2 quarters, you think?
So, given the nature of the portfolio, given the nature of the business, that this isn't a part of it will get utilized. That's fairly certain because that's the nature of that portfolio, really. So it's not like, a standard asset provision as you would call it. And today's investor call had clarified that. It is on an NPA portfolio and therefore it will get utilized. From a normalized credit cost perspective, however, it's important to understand that our year-to-date, if you take the year-to-date 9 months and annualize it, our credit cost is at about 41 bips. And this quarter, yes, is at about 58, but it will normalize itself around 41 to 45 kind of levels going forward into the future.
Ms. Warrior, just to complete this point on asset quality, and then we'll move forward and talk about the growth in the business. When I look at the other internals, whether it's the gross NPA ratio, which has improved, and these are quarter-on-quarter trends that I'm noticing. The GNPA has improved. Your restructured book has actually come down sequentially by almost 5%. The only hiccup is slight increase in the slippage ratio. I think you're at 0.86% now. Plus the fact that, in a prudential manner, you've taken provisioning upfront ahead of time. So what do you really see ahead at a GNPA level? If you could guide us, could there be a couple of basis points higher in the future, maybe on unsecured, maybe on the retail book? Where do you see the stress building, if at all?
Yeah, so our slippage ratio, as you rightly pointed out, remains sub 1%, as you can see, 0.8 to 86 in that range-bound level from a slippage ratio. We don't expect that to change materially going forward into the future. Our unsecured book is still a very small component of our total book. And therefore, to that extent, from a slippage ratio perspective, we don't expect it to materially move. We don't expect, as I said, credit costs to be, which is really the real indicator ultimately, to be in the range of about 40 to 45 bips. Our PCR, as you would have noticed, is at a record high of 74%. So given all of that, we are guiding for, I think the focus is really to guide on a credit cost, which is around the region of about 40 to 45 bips.
Okay, all right, got that point. So now let's move forward and talk about the next interesting piece, which is the margin profile in a fast-changing environment, right? Just this morning we've woken up to new measures from the Reserve Bank of India. If you could just kind of weigh in on that, to what extent does it sort of alleviate the liquidity stress? And on margins yourself, I mean, you're at about 3.11%. So it's a climb down by a couple of notches year on year, slightly lower quarter on quarter. Where do you see margins stabilizing, and what are you penciling in terms of the policy environment? I mean, if there are more rate cuts, then what happens? If there are more liquidity announcements, then what happens?
So I'll take it in two parts. I'll talk about the deposit side and then the asset side. Clearly, our understanding and belief has been that's really the deposit side that drives NIMs ultimately. Yes, the asset side will, but over a period of time, it's really the deposit side that weighs in much heavier on the NIM perspective. Our guidance on NIM, therefore, remains around the same level as we've been talking about. Why do we say that? So let's take the deposit side of the story first. You would have seen that some of the metrics that we measure very carefully on the deposit side are actually showing an improvement. While Q on Q, year on year may not look as attractive as it is, Q on Q is definitely could have been better. There has been certain structural changes we've done on the deposit side. For a very long time, we've been focusing on the fact that we need to move our averages to look better. So if you look at an average SA growth this quarter was as high as about 2.3%, 2.5% actually on Q on Q. Current account growth on the average was about 1% Q on Q. Overall, CASA has actually grown on an average at 2.3%. While that does mean that the levels may not have been as attractive as it should have been, the averages are really where the NIM gets impacted. The second aspect of it is our granular deposits have shown an improvement. As an example, the top 20 depositors, which were at about 7.43%, you'll see in our investor pack is down to about 4.8 odd percent, the top 20 depositors. So we're reducing the focus, reducing the concentration of the top 20 depositors, the concentration on financial entities, the concentration on wholesale deposits. And that has improved the mix of the deposits and the growth and the composition of our deposits. That should help us from a NIM perspective in addition to the other measures that you alluded to. If you look on the asset side, again, overall growth has been muted this quarter. But if you splice it down and it's there in our investor deck, you'll see that certain medium yielding to high yielding assets like commercial banking is up actually 25% year on year. Loans against property is up about 18% year on year. Or retail auto loans are up about 25% year on year. These are all the medium yielding assets. Whereas if you look at housing loans, which are in the low yielding category, they're actually just up about 8 odd percent, 9 odd percent year on year. So we've been calibrating on the advances side also. We do believe there is still headroom to grow on some of the high yielding assets, whether it's credit cards or personal loans or microfinance. But given the current environment for the next 2 quarters, we'll probably not grow personal loans too much, not grow microfinance too much, but we'll definitely grow credit cards. So a long answer to the short question is NIM is, we're guiding around the same levels as which we are. Yes, there will be an impact on the rate cut that is likely to happen or not happen. We don't know. 50% of our book is linked to the repo. So yes, there will be some impact, but some of the most strategic reorientation we've been doing on the deposit side, as well as moving more and more towards the medium yielding assets on the asset side should help our NIMs.
Okay, so NIMs will be where you are, which is around 3.1%. Just a quick number and outlook on the AUM growth, FY25, what will be the exit number and the growth rate?
Growth rate would be about 1 to 1.5, 1.5 times what the industry would grow. That's what we're guiding for. Yeah.
Okay. All right, ma'am, we'll leave it on that note. Thank you very much. That was an exhaustive understanding of everything that's happened at Federal Bank in the third quarter and, of course, the outlook going forward. So they're looking at building their deposit franchise, and all things put together, NIMs should remain stable. That's what the guidance is. We'll take a break on that note, come back on the other side, and we'll have Manisha Gupta joining in with the latest commodity cues.
I mean, 100 points on the Nifty, but it doesn't tell you what's happening in the broader market. because look at if you can pull up the NSE advanced decline ratio, it'll give you a quick view. 5:1 in favor of declines. So that's the picture out there on your screen now. Yeah, there you go. 2,000 lower and about 450 stocks are higher. So this is the problem and the crunch point. And you know, this was true yesterday as well. Today, of course, the market is up 80. Yesterday, the Nifty was down 1. Small cap index was down 3.5-4%. So there's a bit of a divergence now because broader markets continuing to collapse, but large caps are not collapsing anymore. I mean, they're hopefully sort of stabilizing a little bit, at least relatively speaking in that sense. But there is a fair bit happening in the broader space, which I think we can address with individual names, etc. as we go along. It's all, I mean, the upside, of course, it's all largely financials as expected. The top volume-led gainers across the board in the market are ICICI, HDFC Bank, Axis Bank, Union Bank and Bank of India. So, you know, that is those are the 5 top volume-led gainers, all from the financial space. And I think about 7 or 8 out of the top 10 would be financials because there's Chola, AU Bank, Piramal Enterprises, etc. as well. IDFC First, for example, which is coming back up a little bit, coming through as well. Easier to, of course, I mean, you know, look at what's happening in this list because otherwise it's actually a sea of red in the broader space, in the broader markets. Well, Mitesh is with us with what he'd want you to do. Mitesh, this divergence, I mean, large caps and what's happening in the broader space, what do you make of it and what would you do now?
Prashant, 2 things. One, I think, you know, you were highlighting the divergence. I was looking at the Bank Nifty and the rest of the indices. I think it's clearly the first signs of reversal which are now visible on the chart of Bank Nifty. So disclaimer, I have some long positions which are taken today. There's a gap of, you know, and then there's also a chance of a double bottom. We got a closing of 48,041 on the 13th of January and a closing of 48,064. So that's roughly about 20 points away difference. But it's, you know, on the chart, which is a 50,000 in a kind of value index, I think this doesn't make any difference. So 2 lows at the same price and then a reversal with a gap. The idea is that if this gap sustains, I think I would look at a first target of around 49,300 to about 49,500. Then possibly 49,700 to 50,000 and then possibly even more. So this could be the first sign of reversal on the Bank Nifty. So very clearly from a trading point of view, I think the focus should be on the banking names. I have a buy on HDFC Bank, which I would recommend buying now with a stop at about 1640 for targets of 1700 to begin with. And above that, we'll look at higher levels. While also a buy on ICICI Bank, which I would recommend buying with a stop at about 1239 for a target of around 1295.
Okay, all right. Got that, Mitesh. Thank you very much for the trades. We'll come back to you later in the day. But for the time being, let's figure out what's happening in the commodity markets. Manisha is with us. Manisha, so what's making headlines today?
Well, I'm looking at the steel prices because we've seen prices rebound from its lows. Remember, the last couple of years were not so great. But this year, we are trading at a flat note right now, and the steel prices actually have rebounded from its lows. One, the US seems to have relaxed the tariff rhetoric on China in some sense, and the buyers have come into the market. The second point is that there is buying ahead of the China and Lunar New Year holidays. These holidays are from Jan 29, which is tomorrow, and go on until Feb 4. So there is some buying that the markets have seen ahead of these holidays. The third important point to watch out is the World Steel Association report, which says that the global production has declined for a 3rd straight year in 2024. So these are the major 3 points that seem to be supporting the steel prices right now. If you look at the numbers itself, the global steel production numbers, that is, they have come out telling you that global production, while last year was 1.89 million tons, this year is last year was around 1.88. So we have seen a bit of a decline come in for this one. Apart from that, when you look at the steel production between the countries as well, China continues to hold 50 to 55% of major market contribution there. So even as India is the 2nd largest producer of steel, you can see that we are really far behind in sense of numbers there. So the Chinese steel numbers have seen a decline on an year-on-year basis, and the Indian steel production has seen an increase. But as you can see, the numbers are really not relevant in that sense there. Also, when you look at the 2025, the markets do believe that the steel demand itself could see a bit of a decline, and this would be a 3rd straight year of that to around 1.75 billion. So we are looking at slight surplus in the international markets there. The second point is that you are looking at weak manufacturing data, not just from China, but various other major global economies as well. And this has happened for last couple of quarters now. The third important point
point is about political instability, and you also are looking at regional conflicts. Those continue to weigh onto the markets right now. So even as we're looking at flat markets and we've rebounded from those 2-month lows that we started the year with, not too many people are very bullish on steel prices going forward.
Well, Manisha, thank you very much for that. As commodities and steel is on Manisha's mind today. 361 is the stock in focus. There is M&A here and potentially more coming. Vamakshi is here to kind of summarize the news flow around this one. Vamakshi, over to you.
Well, absolutely, Prashant. Let me first start off with the numbers that the company reported in the third quarter this time around. The annual recurring revenue saw an uptick of 7%. This came more or less in line with the street's expectations. The transaction and brokerage income, however, saw a dip of almost 6% sequentially. This is much better than what the street was expecting, and resultantly, the overall revenue, even though it grew by 3% quarter on quarter, was higher than street expectations. The cost to income ratio, on the other hand, was up 196 basis points sequentially, led by higher employee costs and admin and other expenses. The operating profit did see a dip of 1% sequentially, but came in higher than street expectations, and the net profit was up nearly 12% sequentially, driven largely by a higher jump in the other income. Apart from that, the company has also said that its total AUM was up nearly 2% sequentially. The average RR AUM, which is the annual recurring revenue AUM, saw an uptick of almost 4%. Now, more importantly, the company has announced acquisition of B&K Securities as well as Batliwala and Karani Finserv Private Limited. For B&K Securities, the total consideration is at 1,774 crores. At an FY24 turnover of 144 crores, the price to sales ratio comes in at 12.3 times. While for Batliwala and Karani Finserv, the total consideration is 109 crores. At an FY24 turnover, 13.38 times. The price to sales actually comes in at 8.1 times. The management says that the strategic acquisition will help the company bolster its broking platforms across all market segments. In addition to that, it is also expected to aid in growing the equity capital markets business to serve its existing client base. So both of these actually bode well for the company. But apart from that, there's a note that came in from Kotak. They say that the company's results beat expectations. The standalone B&K business adds another vertical, but it is important to assess B&K's fit into 361's core proposition as it needs more clarity. For now, they say that the valuations are relatively expensive. They have a reduced rating on this counter, target price of 1,150 per share.
Okay, all right. Vamakshi, thank you very much for that. So that's the stock in focus today. And, we'll have more for you. We'll take a quick commercial break. And on the other side, we come back with our segment. It's the economy. Lata will be in conversation with Pranav Gundalapalle of Bernstein and Santanu Chakrabarti of BNP Paribas. We'll discuss RBI's liquidity measures for banks, NBFCs, and of course, is there more coming on the 7th of February. Stay tuned.